Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Kearney. Lee is a highly experienced and is one of the most successful single-family investors in the nation. He began his real estate investing career in 2004 and has since transacted on over 7,000 properties, totaling over $500 million, all under his company, Southeast Property Investments Network, or SPIN. His educational platform, Flip Your Income, offers many levels of training for beginners and even more experienced operators who want to scale their businesses. So Lee, welcome to the show.
Thank you.
Yes, sir. So Lee, tell us a little bit about your background, how you guys started in real estate, and, we'll do the traditional introduction, like we do on every podcast, and just, we'll kind of fast forward to the nuts and bolts of, the interview.
Sure. Yeah. I started by accident in 2003, bought a condo back in Ireland, which is where I'm from, got broken into, sold it, cashed out in 3 months, made 35 grand. Actually, it was 35,000 euro at the time, which is a little bit more in dollars. And I said, I'm just making more money in this than my job. So that's when I got the bug for real estate. Moved to California in 2004. Interestingly enough, I didn't really understand. I was trying to find a mentor. I was just asking a bunch of questions. Found a guy I was going to church with. He was flipping houses. So I rode around with him. I was helping him work on these houses. His name was Craig. And Craig showed me where to buy, what price to buy. And he said, you really want to find a probate deal. I didn't even know what probate was, but I told my realtor I need a probate deal. So she found me a probate deal, was priced right, offer was accepted, cash. I actually borrowed hard money, used the 35 grand I had as my down payment. So kind of bootstrapped things together, moved into the house, which was my first mistake and my first rehab. So I'm trying to rehab a house around myself to save some money. Anyway, stumbled through it, electrocuted, plumbing leaks, had an antenna fall. Everything went wrong. Made a little over 30 grand on that. And in fact, outside my office is that first deal where I bought and sold it. About a 3-month turn on that, which was crazy. When you scale up, you realize it's about a 6-month turn on rehabs. But that first deal, even with all the mistakes, start to finish. So now I'm 2 for 2, 3 months on my second deal. Parlayed that money into my third deal in California. Then I made my second and third mistake, both my second real flip. I ended up moving out of state. So I'm trying to rehab it from Florida in California. That was a mistake. Hired a friend to do the job. That also was a mistake, but somehow stumbled through that job, made a couple bucks, I think 10, 12 grand. And now I'm off to the races. So moved to Florida, asked a bunch of questions. Where do I buy houses? And they told me about foreclosure auctions. I didn't even know what a foreclosure auction was. I asked all those kind of questions. What's a foreclosure? Where are the foreclosure sales? How often they go on? And one of my friend's fathers kind of showed me where to be at what time. So when down there was like a used car lot, it was actually a lot full of used car salesmen is what it was like. Everyone knew each other and winking and nodding. And so I'm sitting there going, man, what's going on here? A bunch of numbers are being sold, or their case numbers. It had no idea what was going on. So after a couple weeks, found a lady who was selling a book, this magical book, turned case numbers into addresses. And then it turned the addresses, also gave a title search on those. I didn't even know what a title search was. But basically, from my perspective, buy, don't buy. I had her explain, should I buy it? And so I kind of understood that first mortgage is better than second mortgage. Anyway, my first house I bought was a homeowner's lien. So despite all that education, I didn't even buy a house. I just bought a lien on the house. So I called up the bar because I'm freaking out. I had to fund this thing the following morning. It was only 7 grand. And I talked to this guy in California. I said, hey, man, I bought your house. I need your social security number so I can look up your mortgage balance. Wow. He was super cool about it. So he gave me some okay. Realized he's not 100 grand delinquent on his mortgage. About what I thought it was going to be was his payoff. So sweet. Funded that deal. Basically, that was a subject to deal at a courthouse. So made money on that. Started doing that over and over again. Did about a half dozen deals, maybe a little bit more than that in 2005. Quadrupled that in 2006, doubled that again in 2007, and by the end of 2007, lost everything.
Wow.
I looked around and I made and lost a couple $1 million in 2 years. So that was a tough pill to swallow because what did I do wrong here? And I learned 2 really, really good lessons in real estate. One, there's always money in real estate, but the problem is you got to be on the right side of the trade. And I was just on the wrong side of the trade. I'm rehabbing houses into a downward market. And that just made no sense. In fact, on my beating on the way out the door, I was selling properties for less than I bought them for before putting rehab money into them. I mean, the market was literally just tanking. So
Right.
yeah, it was pretty crazy. And when I look back, what was really, really funny, I saw signs at the beginning of 2006 that there was problems, but I'm still rehabbing all the way through 2006, and then realized I'm in real big trouble in 2007. But if I'd been paying attention to the market, so what I would say to everybody out there, pay attention to the national market and pay attention to your local market. If you're looking, you'll and you're honest about it, you'll see what direction the market's going. And it's important for us, especially if you're going to value add today and try to sell tomorrow where you're not wholesaling, you need to know where the market's going, because a wholesale deal is great. You buy today, you sell today, no harm, no foul. You really don't care what the market's doing. You just want to make sure you got a buyer for more money than what you paid for it. And even something like multifamily, if you go buy it in a stable area and you build in a margin of risk there, you can lower your rent, keep your occupancy up, and you can still weather that storm. But with single family fix and flip, if you don't nail the formula down, you just end up losing money and you can go out of business because you weren't looking at the market. And even within the market, you got to be looking at the sub-markets within the market, because some sub-markets are great and some markets are not moving at all. So, when I look at flips, I'm looking for desirability of the area, school districts, things that really drive demand. I'm looking at my competition. If I'm feeding into a house with 20 other flippers, we're all going to be competing on price because there's an oversupply of that product right in that sub-market. So these are the kind of things I've learned over the years that I pay more attention to now than I did, 12 years ago when I got my ass kicked. But, that's what makes winners in business. It's not that you make mistakes. Everybody makes mistakes. It's whether you change direction of your business or just keep on doing that wrong thing.
Yeah. And that's a great point they bring up. If something, if the environment changes, then you have to kind of change with it, right? You can't force something that's not there anymore, right? So I want to kind of go back, to, you mentioned in 2006 that you saw some key indicators that kind of give you those, those light bulbs in which, it's going to change. It's going to change. But, what exactly were those? Was it an oversupply of, of properties? I mean, give us a couple key indicators that you actually specifically saw for anybody out there flipping, to kind of look out for today.
Sure. Those pre-indicators were, there was an imbalance in the market. It was completely a seller's market, which means on the buy side, you were overpaying for deals. I was working off razor thin margins just to get a deal. So if you find yourself in a market where you're chasing that deal just to get it at any price, that's the first indicator that there's an imbalance. It's an extreme seller's market, and it means that you're driving up prices very, very quickly. I saw prices between the beginning of 2005 and the end of 2005, in some cases go up 10, 15%, and maybe even 20% in super desirable areas. So I could tell when I look back that things are just running up too quickly. It's not a normal market, and there's a complete imbalance. And because of that imbalance, where there was a huge investor demand and low supply, it fueled that rapid appreciation way too quickly. And that was kind of like the last hurrah in the market before things started to flatten out and then ultimately start tumbling the other direction.
So are there some markets that you're particularly looking at today that may be a little bit more resistant towards a big correction like that, that you're active in today?
Sure. Yeah. If you look at historical trends, I mean, you get into places like Iowa, there's not a lot going on there, which is not a bad thing, by the way, because if your pricing and your exit is stable and you can buy right, you can carve out consistent profit. But if you look at markets like California, Arizona, Vegas, Florida, I mean, you get into real cyclical markets like that. For instance, Vegas, I was having a conversation with a rehabber just yesterday at the IMN convention. They're selling back into that median price in the high 200s. That's about where things fell apart about 10 years ago. And in fact, that market tumbled from high 200s down to about mid 80s, literally in about a 2-year period.
And this is which market specifically?
Las Vegas.
Oh, Las Vegas. Okay.
That's a prime example of that, of a cyclical market that comes all the way up and comes all the way back down again. And that's crazy. I mean, you can make money if you're on the right side of the trade, but do you want to really be rehabbing a ton of houses at the peak of the market? Because once the investors pull out, you've got to now sell it back into a downward market, and you're just chasing a downward market. That's a terrible place for a rehabber to be. It's fine for a wholesaler because the price is lower, you buy lower. Price is lower, you keep buying lower, and you just chase the market down. That's why I'm a big fan of wholesaling right now, because it takes risk off the table. And so, like you'd mentioned earlier, one key thing that people don't do is they try to carve out a strategy, but they're not willing to change it if it's working against the market. And what I would say to you, and even myself, I was out at the convention over the last couple of days trying to figure out what direction I wanted to take my business for 2019. Because fix and flip in Florida is getting tough. And the two things that are compressing margins are the resale price is becoming not as stable as it was. It's flattening out, which means even if the market's flat, if you want to sell today, you got to sell below market to move that asset today to really incentivize the buyer in a more normalized market. Then on top of that, there's a run on labor, there's a run on materials, which means the rehab price is going up. So if you're still buying at the same percentage of ARV and your rehab is going up and your resale is coming down, at some point you either squeeze your profit out or you squeeze it out altogether and you're into a loss situation. And we're seeing that those traditional formulas are going out the window. And one of the big things for us is CapEx has gone through the roof. And literally roofs are more, electricals are more, plumbing's more, materials are more. There's a run on labor, so that the old formulas of you would double your materials and that's your labor, that's going out the window, because you've got a huge, big demand for labor, which means the investors that are paying bottom dollar are not getting the best labor if they're not willing to pay a better price.
Yeah, no, those are some really good points that you bring up there. So, there's a lot of key things that you have to add into, and factor in today's market versus, 5-6 years ago, and whereas, 5-6 years ago, you could have made an easier profit, all day long.
I can tell you why. I can tell you why, because appreciation fixes a lot of our mistakes. So if you make a mistake in your rehab, a rising market will forgive you.
Mm-hmm.
But if you've got a market that's stable and you screw up on your rehab, or you're off by 5% of your price, and even let's take that. If you're off 5% of your price and 5% of your rehab, as far as the total dollar goes. Mm-hmm. So if you budget 20 cents of the dollar on your rehab and you went 25 cents, and you budgeted $1 as a resale and you actually sold at 95 cents, and let's just say you really screwed up and you went 3 months over, so now your holding costs eat up another 2 or 3 cents of that dollar. That situation alone means you can lose money, because ultimately rehabbers are working off a 10-15% net margin after all costs. So a 5-6% swing on both your resale and your rehab completely wipes out your margin. So that's the kind of environment we're in today. And all of the money is made in the efficiencies. Because it's so competitive, you've got to make sure you do everything right. You sell it quick, you sell it at the right price, you rehab it quickly, you rehab it right, you rehab it on budget. Otherwise, it's a scary place to be. For non-professionals are going to find themselves weeded out of this particular market today very quickly. And I saw the same thing last market cycle.
So how many offers are you seeing, like, on any particular, project or property? How many offers are you seeing out there today versus, 5-6 years ago, on average?
On the MLS, if it's a hot property in our local market, just to take an example, there's going to be 50 offers on one house.
50 offers?
Yeah.
Wow.
Yeah. So new stuff on the MLS or on market deals are basically a waste of time. And we spoke a little bit before this about multifamily. That's another place that's overheated. If you're looking at multifamily in a primary market, forget about it. You've got low single digit cap rates, and it's driven down to the point that I don't see an arbitrage for an operator like me. Now we're looking at some secondary markets and tertiary markets, especially in the South. You can pick up these units for 30 grand or less a door. I can make those numbers work. But here in Tampa, if you're buy price and then you've got to add value on a class C is 50 grand, there's nowhere to go with those units because the numbers just don't make sense. You're already starting out at an 8 or 9 cap, and that's a tight margin. If you look at the cost of capital, for instance, those rates are rising. And if you're taking down a commercial rate at 6% and you got an 8% cap rate, I mean, you'll find that if anything goes wrong, kind of going back to what we were saying before, major CapEx, major vacancies, any kind of reduction in rent, where there's an oversupply, you can find yourself a very, very tight debt covered service ratio. And there's a lot of lenders that are underwriting at 1.2. And to me, that's crazy. I mean, I want to be at 1.5, 1.6, 1.7. I want to have lots of room there to be able to service my debt. But there's new operators because of competition. if you're buying $100 doors at a razor thin margin, it's still a razor thin margin. You're not going to make more money because you're buying 100 doors. In fact, you've got 100 times the risk on one building you do on one house. So I look at multifamily maybe a little bit different. I think it's a great space to be because, again, you can have 100 source of income in one building versus 100 properties spread out geographically. So concept-wise, I get it and I like it. But once we decided to shift to our direction, we're passing over a lot of deals. Now, I like commercial from the standpoint, triple net leases. I like that predictability and income. So I consider that a stable asset class. So as we look at 2019, we are going to target multifamily in these secondary and tertiary markets that have a good demand, that are close to, places with good demand for jobs and work and close to bus lines. We're looking for all the things that are going to add some stability. What we don't want, if you get into a town that's dying where people are leaving that town, you can pick a multifamily at 10 grand the door, but there is no one to rent it. So you've got to really look at those fundamentals and see what's going on with the industries in those towns and those locations and those micro markets. And that's a lot of what makes my decision in buying multifamily. But single family is, to me, for our business, is running its course as far as the fix and flip model. I think it's going to make sense for the next couple of years to really transition to wholesaling, see what's going on as far as pricing goes, as far as exit price goes. And even take Florida, for instance. Liz pendants have doubled over the last 12 months, year on year. So things are starting to heat up in the background. Even though the default rate is low, it's starting to rise. So I'm seeing the same kind of signs I saw back in the end of 2005, early 2006, that there's a problem coming. Now, obviously, it doesn't appear that there's a global meltdown like there was 10 years ago. But still, as far as normal real estate cycles go, it does appear in a lot of primary markets that we're coming to the end of that cycle, which means taking risk off the table is just as important as making money. Because, again, you've got that 6-month market risk. If you buy a flip today that's a retail flip, you're not cashing out of that until really about 6 months from now.
Right.
So real estate markets tend to decline or appreciate over quarters. So 2 quarters from now, the market could look different. And even if that's a 10% swing, going back to my earlier example, if you sell your asset 10% less, you're probably not going to be making money on that.
Yeah, those are some more very good points. I want to go back to your points earlier. So you're not doing this so much. You're focusing more on wholesaling these days, right? As you mentioned earlier.
Yeah, we're working on closing out current rehabs, being very select, kind of like we talked about before this interview. Select deals that make sense. But what we're not doing is setting up a production line for rehabs, because we're not feeding an asset in and getting profit out the other end. We're seeing that it's kind of hit or miss depending on the markets. And a lot of what's driving that is affordability. So we're seeing with rates going up that the buyers are getting squeezed, and it's really their last dollar that they're coming to the table. That's another sign that prices do need to correct when the rates are going up, which the Feds are doing on purpose. They've got a faucet of money and they're trying to, increase that rate because they're trying to slow down lending and slow down borrowing. So it's all on purpose. They're ultimately, if you ask the Feds, they're trying to create what they call a neutral situation. But a neutral situation for a flipper is not great. You want plenty of cheap money. You want prices going up, and that makes up for a lot of mistakes on rehabs.
Okay. So on a flip, on your flips, your typical flips, what is the bread and butter purchase price, rehab costs, and profit amount that you've been looking for? And I know that you mentioned that you're not doing so many of these anymore. You're kind of scaling back a little bit, but if you found a great deal today, or what is a good deal to you? In other words,
sure, it's 250 grand or less on the retail side. So we're really trying to stay in that FHA price range. Our purchase price is about 50 cents on the dollar, so 120,000 purchase price. Actually, I would argue somewhere between 75 and 150 on the purchase price.
Okay.
And somewhere between 150 and 250 on the resale, and we're making 15% margins on that when things go right. So that's how we underwrite deals, and again, that's net after all holding costs, after all fees. That's a net margin. So you take a $250,000 house, if we can make 35-40K, we consider that a good deal.
Got it. Yeah. And I think most people out there would also agree with you on that. That's a pretty healthy deal. Now on the wholesales, what is it that you're looking for, and what kind of profit margin are you trying to make there?
Sure. We typically underwrite those very similar at 10%, which is why that wholesale margin or that wholesale model has become a lot more attractive
Hmm.
because you cut out the work, the amount of hours. I mean, even if you spend 100 hours in a rehab, the opportunity cost of your lost time in that one rehab, you could probably get 50 wholesale deals done in the same amount of time. So retail to me is becoming less attractive today temporarily because I'm an opportunity chaser. So if I don't see the best opportunity, and it being having a defined profit at the other end of a rehab, it doesn't make sense to do all that work. So really for us, we're transitioning primarily into wholesaling, and I can see us going that direction in 2019 and really staying the course with a primarily wholesale model.
Got it. Got it. Okay. So the other thing that you mentioned was, interest rates going up, for the homeowners, right? And it's gone up also for borrowers of commercial real estate, right? So how do you see that for 2019? Because in 2018 it did go up. How do you see that, playing out in 2019? I've read a couple of different articles, and I've actually read where they're actually thinking about cutting back a little bit. They
You know,
so
it's
I mean,
it's
there's
funny.
Mhm.
I would have said at the beginning of the year that I
Mhm.
for sure saw a rise in interest rates in 2019 and 2020, but they really throttled it up in 2018. Recently, the Fed announced, I believe it was last week, that they
Yeah.
felt like the rates were at a neutral
Mhm.
neutral rate,
Mhm.
which means that would indicate to the market that they're not planning on increasing them. But you've got commercial loans in a lot of cases go off of 5-year swaps and don't necessarily go right off of the Fed funds rate. But single family is almost dollar for dollar off. If they raise it 20 bips, that's exactly what a mortgage is going up. And so there's more of a parallel in single family versus commercial. But the reality is the banks are borrowing more expensive money, which means that's translating in some shape or form to the consumer. And so that is something I'm seeing across the board. And so ultimately, it's really down to the Feds where they see the economy. Because if they feel like the economy is neutral, they're probably not going to raise or lower the rates. If they see a recession coming, they've built up that interest rate where they can drop it back down again to stimulate the economy. So I don't have a crystal ball. I think at the beginning of the year, I would have said I see a definite increase for 2019 and 20. Now, I think I've changed my tune a little bit just based on what the Feds have said over the last couple of weeks. I feel like they think things are at a neutral rate, but the market's very skittish over this. You look at the stock market yesterday. There's a
Mhm.
lot of concerns about the economy, and for those who watch the stock market, at the time of this recording, the stock market, the Dow tanked 3.01 or 3.1% yesterday. That's over
Wow.
800 points in one day. That's how much
Mhm.
it shed. So, or right around 800 points. So the market's very in tune with where the economy is going for 2019, 2020. And I think a lot of that's going to feed into the Fed's decision on rates. I think that the two are pretty closely married at this point. So I don't know, but I think that they're not going to be, I don't think we're going to see the kind of increases in 2019 for sure, short term, that we saw in 2018.
Yeah, no, that's some good points as well. So, and really, there's got to be a point where, if we want to, keep having buyers, buying these properties, then you got to make it a little bit more affordable, because those rates were, pretty much, taking a lot of people out. It was filtering a lot of people out. Then a lot of people couldn't afford these homes anymore. So,
Well,
um,
that naturally drive for the flipper, that drives down prices. I mean, if you take a $300,000 house at a 3.5% mortgage, and now you got a 5% mortgage, that drop, if that buyer was maxed out at 3.5% on a 300 grand house,
mhm,
at 5%, they can probably afford a $250,000 house. So what we're seeing is that buyers are trading down, which
mhm.
means if we recognize that trend, we don't want to be operating above the median line. So our sandbox, which I alluded to earlier, is really that median price, 250 grand or under. And we're not operating in $1 million homes because we're seeing a lot of risk there, especially when you come to mortgage rates going up. Now, if you're into a luxury market with cash buyers, that's a little bit different. The economy is good and people are spending, the luxury market's doing good. The economy slows down, you'll find those cash buyers are going to conserve their cash and not make big expenditures on luxury homes, luxury cars, luxury boats, private jets. And that's where you start to see that stuff curb, and they really curtail those kind of expenditures.
Got it. Got it. So as far as markets, we did talk about this a little bit earlier. which markets are you a little bit more bullish on these days? You know, both from a single family perspective as an investor, and both in addition to a multifamily investor. You know, and I think you mentioned also you're kind of staying away from the primary markets, you know, from a multifamily point of view. And, you know, because these cap rates have gone way down, they've compressed like crazy.
On market, primary market deals are just outrageous. There's just too much demand.
There is, yeah.
I mean, we were looking at a deal, it was 100 doors, $6 million purchase price, and there was no room for me. There was no room where that deal made sense today or tomorrow, and I couldn't see any value add. I couldn't see raising rents. I couldn't see a reposition play. I just saw nowhere to go with that deal. It was just priced right at full retail. And so, yeah, it on paper it has an 8 cap, but an 8 cap doesn't swing the needle for me on multifamily.
Yeah. So which markets are you looking at then? You know, if you're not looking at these primary markets, and, you know, which secondary, tertiary markets are you more leaning, you know, towards?
I'm looking at a couple deals in Oklahoma, just to be honest. That's a market we've looked at. Mm-hmm. We're kind of dabbling with a deal right now that does make sense, but not in Tampa, Florida, not in Miami. You know, we're not seeing our home markets. We're not seeing deals that make sense today. And so, again, I'm looking at 3 ways. You know, is a cap rate good today as a stabilized purchase? Is there a value add here where I can buy it in distressed condition? And then also through that renovation, reposition the property, perhaps from a C or C plus to a B minus, you know, so you can raise rents. Or even if it's still a C class asset, but you can get slightly more rent because it's just so mismanaged with a lot of, you know, deferred maintenance. So, but I'm just not seeing those trading at a price that really encourages me to want to put that amount of CapEx into them. You know, if I'm buying something at 70 cents or 80 cents of the dollar, it needs 20 cents of reno, I'm basically into it for full retail. And, you know, if I'm looking at even a multifamily deal, you know, I want to be buying at 30 cents. I mean, I want to buy something that's completely mismanaged. I'm going to be kicking out the tenants anyway. I don't care if there's 10, 20, 30% occupancy. I need to gut all the units and redo them and completely reposition the entire property, which means in those kind of cases, everybody's got to go.
Exactly. And that's usually the best way to retain a profile on the property as fast as you can anyway. You know, and
or at least clean them out per building, you know, so you can completely redo the exterior, interior of a building. And then, but the problem is if you've got other older buildings and you got undesirable tenants, it's going to be hard to attract the right kind of tenants. It's like anything else. It's a lot of common sense with multifamily. If you're just fixing up an existing property, you can keep those tenants, let them expire, keep the income rolling in. But if you're trying to completely reposition a property, yeah, you've basically got to kick everybody out.
Yeah, exactly. So kick them out and try to get it as, you know, stabilized as soon as you can. So that's really the way to do it. So do you have any tips, you know, for somebody out there that's looking to, you know, they're a flipper, they're a, you know, wholesaler even. Do you have any tips, you know, for them to scale up their business? You know, they want to be a big dog, you know, and so what can they do? What can they do to get it up there?
Systems and workflows and people are the 3 most important things. You got to have the right software and the right tools. You've also got to build out your workflows that are very simple to follow. If you want to scale something up where you're not micromanaging everything, you have to make it very easy where you can just put a new person in the seat tomorrow and they can follow that very easy to follow workflow. So you got a great software, a great system, a really easy to follow workflow. And then you got to hire great people because ultimately you can have a really easy roadmap. You know, your SOPs are great. You're working off great softwares. But if you got someone who's not putting in good data or following your SOP to the team, then it's a failed exercise. Or if you bring amazing people in and expect them to build all those things we just talked about, they're not going to do that. That's not their job. But you'll find that the reason they have a job is because they're not the creator. We are the people with the ideas. So we need to memorialize that, put it in paper, and really focus on building, I would say easy. That's what I'd say to everybody out there. If you make these very complicated systems with very complicated, hard to follow SOPs, you're going to find your success rates going down. I try to make everything easy in my business where basically anybody can do it. And by doing that, I don't need to hire real estate professionals. I need to hire organized, motivated people, and they can jump into that seat and follow my workflow. They don't have to be real estate people.
So to recap, you said people, deal flow. Was that what you said? So
the 3 things that we focus on are I would say the software, the technology side of things.
Mm-hmm.
Secondarily, you can have a great software, but you dumb it down with a very easy workflow or an SOP. And then you got to have great people. So you need all three. So good software, good, easy to follow SOPs or workflows, and then great people. That's the three necessary elements if you want to scale up.
Yeah, I said deal flow. I mean, I meant to say workflow. I'm just so used to saying deal flow.
Yeah.
But yeah, okay, got it. So, okay, some good stuff. So, also tell us a little bit about your program. I know that you have an educational program. It's called Flip Your Income. So, tell us a little bit about that, and how that works, and how people can learn a little bit more about that.
Sure. That was a brand I created with my partner, Dalmar Cross. And the reason we did that is we saw a gap in the market for people to teach real estate that were actually doing real estate. So I said, listen, I'm a full-time operator. I don't have time to do all of the back end of this business, but what I can do is provide real content and updated content. So if we learn something new next month, that's what our students are getting. We also recognize as we bifurcate the market that there's new people who have never done a deal that are going to be way over the head if I'm teaching them how to scale their business. And then there's people that want to scale their business that are going to be bored to tears if I'm teaching them how to flip, like how to assign a contract. So we created two completely different platforms, one for people who have never done a deal, which is our Quick Start program. Then we got our master class and some other elements to that, which are really for mid-level operators wanting to scale up, to be able to do 10, 20, 30, 40, 50 deals a month. In fact, just to give you an idea, in this particular space, I'm taking down about 250 assets this month.
Wow. Yeah. So you're really doing it then. That's 250. Is that what you average a month?
No, it's a particularly big month. We're more in the 40 to 50 range, but we're taking down a package of 211 in one go. So we're really going to flex our system this month. So at the holiday period, we're taking down about 250 assets, about $3.5 million worth of purchases this month.
Nice. Yeah.
Assets nationwide, and we're going to wholesale those primarily.
Good. I mean, that's awesome. Even 40, 50, man, that's still a gigantic number to kind of push out, so, yeah, man, good for you. That's really good stuff. So, yeah, Lee, it's time for our Nuggets of Wealth. And these are questions that I ask every guest every week, and hopefully they are able to help them out, So question number one, what is a good tool, source, or platform that you use almost every single day that can also help others?
Google Suite is by far the cheapest and easiest tool. It's an online shared platform as far as it's basically Excel and a shared platform, which is fantastic. So if you've got teams in different markets, it's not complicated. It's easy to create workflows. And also it's on a cloud where everybody can share it. So I love that tool because it's way easier to start a new project, put it up in a Google Sheet and have everybody jump in and share the same information rather than having to spend a lot of money on a complicated software where it takes weeks to develop the software when you can jump right into Google Sheets. I like Google Sheets. I like Google Tasks. And so I like pretty much everything Google. The only thing I don't like is their email. So I use Outlook for that. I can find the conversations follow real well in Gmail, but I do like Google Suite because it allows people that don't have a lot of money, that don't want to spend hundreds of thousands of dollars in these really high-end softwares. They can just jump in with a really cheap tool that's easy to use.
Got it. But yeah, I use Google for everything as well. And I would say +1 on that, for sure. What was the best business advice you ever received?
There's a couple. Number one, it's not important to call the bottom of the market. It's important to call the top. Because when things turn the other way, you can find yourself out of business. When the market's at the bottom, it typically would scrape the bottom like it did last cycle for 2 or 3 years. So there's plenty of opportunity to start buying again at the bottom of the market. So I thought that was really, really good advice. And again, I repeat that. It's not important to call the bottom of the market, but it's important to call the top. And then the second piece of advice, which has always stuck with me, leverage is the key to wealth. And so if you talk to the really, really wealthy in this country, they use leverage. They understand how to use it effectively. And that's what I would say to people. Just leverage by itself, but the right type of leverage on the right kind of deal is the way you can scale up to doing billions of dollars, which my mentors are able to play in sandboxes and trade billions of dollars of assets and make tens of millions of dollars a year because they use leverage.
That's another +1 for sure. You got to know how to use leverage. And, that really is the key to success, the
And
good kind of
I'll
leverage.
I'll give you a real quick example, really quick, just to drive on that
Mm-hmm.
point. If you put out 160,000 cash and you make 40 grand on that, your return on your money is 25%. Now you do a deal where it's 160,000, but you've got 150 in leverage on that, and you've got 10,000 out of cash. Your leveraged ROI is 400%. So, I mean, the numbers are just astronomical when you start using leverage, but as long as it's used correctly, and that's where people sometimes don't do that. They think because the bank will lend it to them, they should take the money. They'll do these cash out refis. There's a lot of SFR lenders and multifamily lenders that will give you 80%. And I've talked to a lot of old timers. People have made, have had tens of thousands of doors at one point. And they're telling me 50, 60% leverage is where you want to be. So I would caution everyone out there, just because the bank's underwriting you and they'll give you the money, you got to remember those loan officers make money when they loan you money. Their interests are not necessarily aligned with yours for the next 2, 3, 4, 5, even 10 years. So make sure that you always, especially on a buy and hold, run your numbers conservatively, try to think of worst case scenarios, and make sure that with that worst case scenario, you're at least breaking even. And the reason I say that, if you're in a loss situation, most operators that are in a global loss situation as far as cash flow will not be able to service their debt because they just don't have enough in reserve to ride that out. I mean, if you imagine you're in a multifamily where you're using 10 grand a month, imagine you got 10 of those. How many people listening to this can sustain 100,000 a month loss for 3 years? I mean, that's 1.2 million for 3 years. Do you have 3.6 million in reserves? Are you motivated to keep servicing a losing property and cash flow wise? So these are the kind of things that I really try to caution people that I teach to really think about these things and make sure not to just grab the money and take the cash out and then spend all that cash out money and not keep it in reserve, because you'll find yourself, if you're in a negative cash flow situation where you're just not able or motivated to service that debt, and then that's where that downward spiral starts, and that's where you see the economy tank, you see over-leveraged people file bankruptcy, and then you see all these properties come back on the market and we're full circle again.
Yeah, I agree with you on that. You can't over leverage, especially in this point of the market cycle. We don't know what's going to happen tomorrow. So like you said, if they are offering you 80%, then maybe it's not the best idea to take 80%. It sounds good, but maybe you want to look in the 50 to 60% range. Like you said, and
specifically, I borrowed 70% at the peak of the last market cycle, and that wiped me out.
Wow. Yeah, I mean, that's a good point. I mean, that's a very, very good point. For anybody listening, obviously, it sounds good, and that's what you want to do. You want to, keep leveraging your money and your equity, but you got to do it smart, the smart way. So that's a very good point. So
I want to be specific for everybody out there. I'm talking about high leverage at peak pricing in a market. Now, if you do high leverage at the bottom of the market, that's fine, because as it appreciates, you're going to see your LTV go down. But if you're at the peak pricing, so if you're at 80% today and prices decline 20%, you're actually 100% LTV. And in fact, one of the mistakes the banks made last cycle was that they borrowed short and lent long. And we can do the same thing where you've got a long hold strategy, but you borrowed short. And if you're into a situation where technically you're insolvent, which means your assets or your liabilities exceed your assets, you can't get refinanced because you're insolvent. So these are real things that we need to consider as we approach peak pricing in a lot of primary markets. Make sure you're not over leveraged.
Yeah. So hopefully, you're driving in the fact that, you can't do that, for everybody out there listening. So very, very good point and very good advice. So Lee, where do you see your business and company in the next 5 years?
We're moving into a equity partnership with a large fund out west. And so I foresee myself in this particular business 5 years from now being a fund manager with $1 billion of assets under control.
Sweet. Yeah, that's a very good goal. Okay, awesome. And last question that I ask every single entrepreneur on the show: at the end of your life, how do you want to be remembered?
I want to be remembered as a guy who helped elevate those around me, and that, as a team we won, and not the guy who was at the top of the mountain.
Yeah, I love that one. That's good. That's good as a team, because That's what it's about. I mean, it's a team. It's a team sport in this, in real estate. You know, you want to keep, achieving success, then it's really about the team. You know, it's not about you, one person. So, yeah, where can Commit to Wealth Nation go to contact you and find out more about what you're doing and, get in contact with you?
Sure. Flipourincome.com.
Simple enough. Flipourincome.com. And yeah, so that is it. So Lee, I appreciate it. You gave us a ton of value, a ton of good information, both on the single family side and the multifamily side. So I really appreciate your advice, and, I wish you continued success.
Thank you. Thank you. Same to you. Appreciate you having me on the show.
Thank you. You're welcome.